Hi everyone, today let's talk about the secret indicator that is warning about a lost decade for the S&P 500. Do me a quick favor and like and subscribe and watch the video till the end to help out the channel, and let's get started. So let's talk about it, a lost decade in the S&Ps. We've talked about this a few times on the channel. We think a lost decade is potentially in play with stock drops averaging around 45%. But let's talk about the indicators they are referencing here, with the first one of those being allocations to stocks. When investors have their allocation at 45% of their holdings, we've experienced losses for the following decade, and you can see that here current reading is 52%. So for the next decade, you're expecting to see a negative return, real losses of around 4% per year, adjusting for inflation over the next decade. So that would put you around the 0 to 2% potentially actually on the year, but with inflation, you're losing buying power. So not a great place to be for markets, at least on the investing side. Doesn't mean you can't trade in the short term. I will absolutely be trading in the short term, but right now, buying markets at these highs, probably not a great time to be doing so. What other investments are there? Bonds, we've been talking about it, bonds, real estate, things with yields. That's what I've been advocating for on the channel. Then they talk about a ratio here, the total value of stocks over the value of stocks plus the total value of liabilities for all borrowers. They say if total liabilities continue to go up, then we should see an expansion of the stock market as the denominator increases, so should the numerator. But if we see those liabilities starting to contract, that is starting to signal a recessionary environment. You want the ratio to stay consistent, but if it starts to decline with that denominator going down, then it probably will not do so, at least over the short term. But this is also a bit of an explanation of why stock prices have to go higher over the long term to keep that same allocation to stocks. The total amount of currency outstanding tends to go up over time, which means the value of things is going to go up over time. It's like the inflation of the stock market. But of course, that does not factor in things like irrational exuberance, which is arguably where we are at right now. But let's look at the forecast for this ratio. Just like we talked about, 52% allocation to stocks, some of the highest levels we've ever seen, going back here to the dot-com levels from 2000. And you can see markets are separated currently from this indicator. Subsequent returns are very, very high, but if these do come together like they have been, the expectation is for that minus 4% on a real return. Of course, this is the subsequent 10 years, so this is where we're at right now. The expectation is that this will trend lower over time, giving you that negative real return. And then they kind of summarize it here. Should you be worried? Generally, yes. The indicator is one of the best we've seen over the next 10 years, and it is signaling not a great time, but it's not flawless. They say it has actually returned better returns than the indicator has predicted over time. And of course, this time could be different with AI pushing markets higher potentially, or maybe having a higher average stock allocation indicator in your indicator watch list might be valuable over the medium term, but you can see it here. When we were super allocated to stocks, that was the 2000 dot-com bubble, and then we had a last decade after that, and we are right back to those levels here based on allocation to stocks. Are we going to see another kind of consolidation to sideways dip? It does seem likely, and you can see it here as well. One of the peaks back in the 1970 timeframe ended up getting a sideways decade as well. So we've seen this before. Is it likely? I say yes. I've been talking about it on the channel for a while. What is the opportunity? Buy things that are cheap, buy things with yields in the short term, reduce your allocation to stocks, and as stocks go down, then you can dollar cost average back into them, in my opinion. Looking at fear and greed, we finished the week at a 27, down from a 32. You can see we did peak out around 38. We've since retraced all of that move since the beginning of the year back into almost extreme fear. Most of the metrics are in extreme fear. Definitely the top three are in extreme fear. Put call ratio now elevating almost to this peak that we saw in December with consistently higher lows here. Probably going to push towards that 0.8 area in my opinion. Volatility also spiking to that 20 area, also eclipsing the most recent high. Safe haven demand back into extreme fear as that continues to trend lower. Bonds are now outperforming over the last 20 days, and then junk bonds really not moving very much, still sitting in greed. Moving over to the AAII survey, surprisingly the bulls are not getting squeezed as much as I would have guessed. The neutrals getting squeezed, the bears are higher than the historical, and I would expect that to continue at least least for the next 2 to 3 weeks, in my opinion. I want to see this get below the 30 mark at least before we start to see a major reversal, in my opinion. So definitely looking for this to continue downtrending in this direction. Less than 1% of a step down. I just don't think we're close to bottoming, at least for now. Moving over to seasonality, we were supposed to have seen the bottom of the month this week. We did see continued selling all the way up until the 10th. Are we going to see that rally through from the 10th up until the 29th, 30th time frame? Seems unlikely at this point, but seasonally it's supposed to be a bullish month. And then looking at the calendar here, first trading day of expiration week. We do have third week options expiration this week, so that's coming up. Treasury budget, PPI, CPI. Bullish day for the Thursday. Historically, you also have a ton of data, retail sales, Philly Fed, imports, exports, housing market index, and then expiration week up 12 of the last 14. Definitely what you would consider a bullish metric there. And then don't forget the Monday markets are closed for the 20th for MLK Day. And then looking at the economic calendar here, nothing really for the Monday. Tuesday, PPI, like we talked about, core and headline, expected to go down just a little bit for the headline number, flat for the core. Same here for CPI, expected to step down pretty substantially. The forecast for core is minus 0.1. The previous number was 0.3, so that is a huge step. Definitely going to be interesting to see if we get that. If we don't, I think that's going to be a big disappointment for markets. We can see how markets already reacted to some really strong jobs data last week. And if we did get a hot number here, that would obviously push out the expectation of potential cuts. So big numbers here for Wednesday, huge impact in my opinion. Still flat for the headline number, going to be interesting. Thursday, retail sales, core and headline, expected to be pretty good, 0.4 for the forecast. And then the month over month number, 0.5 versus the 0.7 previous. Still pretty good in my opinion. Atlanta Fed GDP, 2.7 for Q4. Would like to see that step up a little bit, but still fairly strong. And then for the Friday CPI for the Eurozone, those are usually pretty good, not a huge impact. And that's really it for the week. So bunch of inflation data, Wednesday going to be the highlight in my opinion. And then let's take a quick look at the Fed rate monitor. You can see obviously no expectation of a move here for January. March still expected to be a pause. The first cut potential even really is out until May, and it's still a very low percentage, 31%. You can see the previous was in the 42, 48% area. So markets were more expecting that potential cut before the jobs data. And then June here is really that first 50-50 for that first potential cut. There is a small expectation of a bigger cut, but I don't think that's likely. Sometime between May and June, markets are expecting that first cut. But if that CPI data comes in a little hot this iteration, that can continue to push this out. And then maybe this first cut comes in July. Even here, the numbers are pretty even between May, June, July. So maybe we don't even see that first cut till July. And I think that would really upset markets. So I think that's really the driver for markets right now. When is the first cut coming? And will the economy crash before that happens? I think that's the delicate balancing act that we're seeing markets and the Fed try to do. Moving over to max pain for the end of the week. Massive numbers here, 4.4 million put call ratio, quite high actually at a 2.75. Look at all of these puts in the market, 590, and really no calls until 600. So 590 is $10 above current price. You can see puts here, 580, 585, all of these numbers. And honestly, I would expect to finish between 590 and 600 at this point based on this spread here. So this looks pretty bullish to me. Interesting to see how bullish this looks for the end of next week. And remember, there's tons of options. Puts 3.2 million. I would expect markets to rally here into this week based on these numbers. And then looking at the day by day here, you can see it's bullish all week, just slightly bullish for that Friday at 583, but all week pretty bullish. And even with the Friday up a little bit, about 0.5%. So I would expect a little bit of a retracement. Doesn't mean we can't go lower in the short term, but by the end of the week, I would expect a little bit of a bounce, somewhere between 0.5% and 1%. Moving over to the chart, starting off with the S&Ps, you can see the 21-week moving average was right there at 58.28. We closed just barely below it at 58.27, almost 2% down. Previous week was 0.5% down, so 2.5%. Momentum continuing to show bearishness. if this 21 EMA breaks, your next trend support for me is going to be all the way down here at about 3.75% lower. Is it going to happen in 1 week? Maybe, maybe not. We've seen it like that before. You can look back to 3 September. That was 4.25% down. So the SPY can absolutely do it. We've been seeing some downward trending price action over the past 5 weeks, really. 6 weeks, in my opinion, is what we're going to get. Is it going to get into here next week? Maybe, maybe not. Like I said, the max pain numbers do look a little bit bullish, so maybe we hold up, retest some of these zones, and then continue to sell off after max pain and this 3rd week options expiration. Structurally, right at the 21. If it's going to hold, it needs to do it now. Otherwise, we'll probably see a move like this going back to July, where you break the 21, overthrow it at least to the trend, and then continued on from there. Structurally, we're just still bullish, and that 55 EMA is all the way down at 54.37. I don't think we're going to get there on this dip. It's just too far away at about 6%. I think we'll probably see a dip low, a slight relief rally, and then continuation into that 55 EMA zone on more of a second wave style continuation. Otherwise, all the indicators are bearish, RSI bearish. And then looking at that daily chart here, you can see that lower trend line that we're watching, a potential target in the short term around 57.79. Again, like I talked about on max pain, I would expect a little bit lower here, touch the trend at least. You got the 144 EMA at 57.14. The max pain should have a pretty good effect, but this structure here with the candle close break of this trend line here does look very bearish in my opinion. So you got some competing factors. Market structure does look quite bearish. And then looking at the SPY charts just for some levels, 579.78 is the level. We closed pretty much right at it. Trend below that at 577.62, and then below that 574.71. with dynamic support all the way down there at 567.42 at the 144 EMA, momentum bearish, RSI bearish. If you do get that continuation down to that next trend, that's about 2.25%, especially now that we are below all of these short-term EMAs. The structure does look quite a bit more bearish. And then looking at the Tasty charts here, we pulled back to that 21 EMA. You can see the same level there on the SPY charts on the weekly. Still in bullish conditions. The ATR trailing stop is at 565.09. It's been there for 6 weeks in a row now. My guess is that we're probably going to get into that range within the next 2 weeks or so. Everything here says this is a little bit bearish as well, at least in the short term. Still bullish conditions. Your support on here is that 34 EMA at 565.70, so pretty much in line with that same level. We're at the midpoint. If the midpoint breaks, your first target is that first lower ATR band at 567.02. Obviously, that'll step up just slightly for next week, but not by much, maybe 568.30 or so. Momentum still bearish. Everything looks a little bit bearish in the short term, except for that trailing stop. And then you can see it here on the daily chart. We've been talking about this for a while. It is in bearish conditions. All the short-term charts are now in bearish conditions. Your trailing stop to the upside is at 607.94. And with that break below the 89 EMA on the daily chart, your next target is that 144 all the way down at 569.52. Pretty much in line with that lowest ATR band at 570.92. And I also wanted to highlight here, you can see the breakdown. We hit this lowest band, pulled back to the mid-range. The mid-range was your resistance. We sold off from there. Once again, hit this lowest band here on the second, pulled back, hit the mid-range again, and then continued to sell. So the market continues to do this kind of rolling over price action. Can't get above the midline. And when you see that midline rejection, usually your target is going to be that lowest band, which like I said, is at that 570.92 area, or about 2% lower from here. Then moving over here to the NASDAQ, you can see 2.24% on the week. Momentum still bearish, RSI breaking down from the SMA. While it does look quite bad, we have seen this before. We did overthrow it really powerfully back here in August, and then we broke below it as well in September. And both of those ended up rejecting and then going higher over the next couple weeks. So the question is, how much lower is it going to go here? Are we going to continue to see this consolidate and break structure? Or is it going to bounce from this 21 EMA at 20,457? That is your next level. And with that move, that would be about another 2% lower, 1.8 or so. Not to say that the close below this trend isn't something to consider, but we have done it a little bit here in August and September, like I mentioned. And then looking at the daily chart, it does look much more bearish. Again, you can see those breaks below. Hit the 200, bounce from there, hit the 144, bounce from there. So if we did pull back to the 144, which I do think is within range at this point, that is 3.5%. It's doable in a week, probably not in a couple of days. Momentum still bearish, RSI still bearish. You can see the retest on the SMA, so not what you would want to see. Breakdown, retest, breakdown, lower low on this. How much lower is it going to go? Probably into the 30s, I would say at least. It's right now in the 42 area. And then looking at that daily structure just for your levels here, 503.52 is my level. You can see we just missed it. The low of day on the Friday was 503.92, so we missed it by about 40 cents. My guess is we'll get a touch of that on the Monday session. We'll see what happens once we touch there. The structure that we've been watching seems to be playing out quite well. Got the top, second touch here, third touch, overthrew it pretty powerfully, but then broke down strongly the next day. Got the touch of the low here, which resulted in the bounce. So the initial trend was here to here. Third touch here. Fourth touch would give you a target in here around that 500 area, 499.80, somewhere in there. And then my level, 498.44. So we'll see if this continues to play out. And if it does, that should give you a little bit more bearishness. Again, 503.52 is the current support. And then looking at the NASDAQ here on the Tasty charts, you can see we're below that 8 EMA on the weekly, but the 21 is still holding up at 521 cents. Momentum stepping down. We did break below the 8 on a closing basis. That hasn't happened too many times, especially over the last couple of weeks here. You can see we've been holding up really well above it. Still bullish conditions, ATR trailing stop at 476. So as long as we can hold that, still considered to be bullish conditions on the weekly chart, in my opinion. And then below the 21, you got the 34 sitting at 486.41, definitely within play at this point over the next 2 to 3 weeks. And then looking at that daily chart, we've been talking about the bearish conditions. We've been in bearish conditions since back here on 19 December. We've now closed below that 55 EMA on the daily chart. Your next level is the 89 right there at 502.44. Didn't quite touch it. Again, expecting to touch it there. And you can see the NASDAQ on a structural basis has held up really well, actually. We haven't gotten to that lowest ATR band, but you can see the bands definitely trending here to the downside. Upper band is still relatively flat, but you can see starting to curve over the last 3 weeks, definitely curving lower on the lower bands. And within just a couple of days, my guess is that lowest band is going to touch your 144 EMA, which would put that in play at 489.80. And just to remind you, we've seen this huge volume, huge selling volume here. That was the FOMC. All of the retracements have been sold, and you can see seems like we're going to get a lower low. We already have on a closing basis, but I would expect 1, maybe 2 more candles. Then you get the lower high and then continuation style move. And then looking at the Russell here, you can see generally the structure is up and to the right, but on the short term here, close below the trend. First time we've closed below that since really back here in September. We had the big push up here, chopped on it a little bit, but since that September candle, we've been above it on a closing basis all the way through here to the beginning of January. Now we are below it. Your next dynamic support is going to be that 55 at 211.34, which is really just $5.50 lower from current price, giving you about a 2.75% potential. Momentum bearish, RSI bearish, volume ramping on the selling. And then you can see the trend support just below it around that 210 area, maybe a little lower, 209.50, somewhere in there. And then looking at the daily chart, the big one is the 200. We haven't been below the 200 in a very long time. You can see going back to here, we did break below it in September of 23, broke back above it here in December of 23, and then we've been trending higher ever since then. We did have one touch back here in August, and since then it's been a rally through. Now we are back into that 200 SMA zone once again, waiting to see what happens. Definitely interesting structure. This looks a lot more like a bear flag, which is a little scary. So you got a huge move down, kind of bear flag set up in here. Now we've broken below that structure. And if that is true, then you would expect a much larger down move. Definitely into this trend area, like I said, 209.50. And just to throw some levels on it, the ones I've been talking about. Broke below 218, my next level 214.79. That is the consolidation lows from here and here. And then the next level 211.88. You can see the candle breaks here, continues to be a relevant level. And then realistically, I think we're probably going to the trend. Are we going to get there in the short term? It's a little bit hard to say. Something I do want to highlight is just how oversold we already are. You can see We hit oversold conditions back here on the 19th. We had a bounce. We have much lower prices today with a slightly higher RSI read. So you're definitely looking at some divergence, at least on strength. You can see the breakdown here on price. Strength sitting at a 34. The low on RSI was a 29.84. So lower prices, higher RSI read. Is this the zone where you're going to catch a little bit of a bounce? Certainly a possibility. Then moving over here to the Tasty charts for the Russell, you can see that next level is the 55 EMA on the weekly. That is at 212.78. Definitely within striking range, just 2% lower there or so. Probably going to touch that before we see a bounce. Momentum bearish. You can see volume coming through on the selling, and we've seen continued selling since then. So probably a big sell for markets. Again, still bullish conditions, trailing stop all the way down at 206.40. But once we rejected from this upper area, probably should have expected a little bit bigger sell. And then looking at that daily chart, this looks significantly worse here on the Tasty charts. Obviously bearish conditions here. We had a break on that 18 December candle. We've been holding at that 144 EMA, and then that broke on a closing basis here on that Friday session. So gap down and fell through there. Lowest ATR band is going to be 211.94. Which is actually pretty much in line with the levels that we talked about. That'll trend down one more step here, obviously, for the Monday session. And then that 210 area that we talked about on the previous is potentially in play, and we even saw a little bit of volume selling on that candle. I would be interested to see where that came through. Was it at the low of the candle? Was it at the low of the candle and then we saw a little bit of a bounce, or was it as we were accelerating lower? So something to consider. You can also see the momentum is slightly bullish. Maybe there is some buying taking place at these lows. And then moving over here to the Dow, on the week it was down 1.8%, right to the level 418.38. You could try to buy the bounce there, but realistically I would be patient. Momentum and RSI both say this is still bearish. We broke below all the short-term EMAs. Your next dynamic support is going to be 400.68. That'll trend up one more step here, maybe 401.30, somewhere in there. Let's go ahead and extend this out. You also have a little bit of trend support in here, 407.60 or so, maybe a little higher, 408. 50, my level 412, somewhere in here. So you've had a pretty consistent down step, two kind of consolidation candles after three down candles, and then a continuation lower here. So realistically, I expect this to get to that 55 EMA at some point, which should give you about another 4% of potential downside. Doesn't mean it's going to happen all in one go, but realistically, that is my expectation. Then moving over to the equal weighted S&Ps just for a moment, highlighting that they were down 1.75% as well. Momentum bearish, RSI bearish. 55 EMA is your target, 169.44. My level 169.76, which is giving you about a 2% potential down move. So overall, pretty much in line with the Dow and the Russell. Moving over to the ratios, looking at the SPY Russell and the NASDAQ SPY, you can see we did get a little bit of outperformance from the SPY, pushed right back to the level 2.66. Momentum is still bullish here, RSI is still bullish, so maybe we see a little bit more SPY outperformance. Even with the down candle the previous week, I thought we'd see a little bit more continuation to the downside there, but didn't play out that way. We're right at the resistance level once again. If the SPY breaks through, that's going to give you the best opportunity out of the three major indices. And then looking at the NASDAQ, underperformed as well. So the SPY was the best. Momentum rolling to the downside here on the NASDAQ SPY. So overall, SPY looks the best here for the next week or two. Moving over to the SPY divided by the M2 money supply, one of my favorite charts when it comes to looking at if we are in a bubble or not. And this is showing some pretty significant downside potential. I think we're going to get a move at the very least similar to the one we saw here July into the October timeframe of 23, which is a pretty substantial move. That was about 9% on this chart. If we did get about a 9% move here, that would take us a little bit below the 55 EMA, a little bit below that 25.9 level, and that is the next level here, 25.9. So we broke below 27.25, closed below it here, and now it looks like we're going to go back down to that 55 EMA. Again, doesn't have to be a straight line. Could be similar to this, where you have a breakdown, a retest, continuation. Maybe you have 1 or 2 weeks consolidation, retest here, and then eventually break down to that lower level. Certainly a possibility, but right now this does look like a topping pattern, seems to be rolling over. We've broken the 9 and 21 EMAs as well as the level, and again, don't forget this is still extremely overbought relative to what is sustainable in my opinion, which is generally this 22.05 level. Doesn't mean we're going to get there anytime soon, but I would expect it to trend back to there, which is about 18.5% lower, somewhere trend there. Then moving over to the individual names here, starting with Apple and Microsoft. Apple closing below that 237.23 level, touched the 21-week moving average just for a moment, bounced a little bit from there, still down 2.68 on the week. Momentum bearish, RSI bearish, volume ramping on the selling. Everything looks not so great. If the 21 breaks, I would be looking back really to the low of this consolidation, somewhere between 217 and 220. Then extending out that trend line here, you can see that would be support around that 220 area, fits in line with that consolidation low. And then looking at Microsoft, we've been watching this for a while now. It looks like a wedge. That 55-week moving average continues to be your support. Right now, that is at 418.20. If we close below that, that is going to be a pretty dramatic shift for me, and I think for markets in general. It was down 1%, so it did outperform a little bit on the week, but 55 has been support since here in August. Multiple tests. As soon as that breaks on a closing basis, which I do believe that it will, that is going to be pretty dramatic in my opinion, and I think we're going to head back down to that 394 area, which was the consolidation low back here from February, really through April at the beginning of last year. Moving over to Tesla and NVIDIA, you can see Tesla was down 3.83% on the week, so did underperform markets, but on the Friday it held up really well. We talked about it in the Friday video, held the trend structure in here, touched the level 384.29. So far it's done well. We did not have a lower low from the previous week. Again, holding the trend. The momentum is bearish, the RSI is bearish. You can see the volume ramping, but it's held up well in the short term. Is it going to break eventually? Probably. It's definitely extended. See if it ends up holding here. If it closes below the trend, there's a lot of downside potential. And then looking at NVIDIA, 5.9%, also underperforming. We caught the trade in here from the previous week up to the all-time high, and then we sold just in time for this to break down dramatically. So hopefully you followed along with that trade, or at least got out so you didn't get taken to the cleaners with this down move here. But as these levels started to break, now we're back to this consolidation low. 21 EMA is your support at 132.44. You haven't closed below that on a weekly basis for a while. You can see back here 3 September. Since then, got back above it the next week, continued higher from there. If that breaks, that's going to be dramatic. We're back into this kind of trading structure here. The low band of that structure is all the way down at 122. With the momentum and RSI breaking back down, I think that could be a pretty bad indicator. You got 130.35 as support and then 124.69 to watch, but I would be looking for this lowest band on this trend structure. Moving over to Amazon and Alphabet. Amazon was down 2.3. Alphabet actually was positive on the week. Crazy to see that. Just 0.02 to the upside. Closed technically below the level, but 193.31 continues to be interesting. We're still holding here. Momentum did step down a little bit, but not as much as Amazon. Alphabet actually looking like one of the best in the Mag 7 right now, but realistically none of these look super great. You have consolidation at highs, continues to slowly downtrend here, bunch of wick rejections at some key trends for Alphabet. It's held up really well relative to markets, but doesn't mean that it's going to swing back up here. At best, I would call this neutral just because it's holding up so well, but either way, these don't look super great. Moving over to Meta and Broadcom. Meta was actually up 1.86. Again, one of the better performers here on the week. The RSI is right at the SMA, continues to chop on it. It's relatively flat here, but you have to like this move on the week. Gap up through the wick to the trend. Want to see it get back to the trend, maybe get above it like we were in here, but either way, continues to kind of melt up with price going back to these relative highs here. Tight stop, 602.95. Not really much to say. And then looking at Broadcom, down 3.5%, close below this trend. Probably has a little bit more downside in it, somewhere between 8.5%, momentum stepping down. You had the huge move on earnings, just super extended, hit the key trends, and now we're selling a little bit. Moving over to staples versus discretionaries, you got staples down 2.5%, discretionaries 2.25%. This is not what you would want to see. We're seeing these kind of sell at the same amount on the week. A little bit of an everything sell. The structure obviously on staples is much weaker. Discretionary is still holding up here at VWAP, nowhere near that 21, whereas staples is through all these short-term EMAs almost into the long-term ones here. Momentum RSI obviously super bearish, but we hit the trend. Are we going to get a bounce from the trend? We did get one in here, but for now, I would be patient. Want to see it react with the trend, get a little bit of a start to an up move potentially. Otherwise, 75.40 is the next to the downside. We've round tripped all this move from June through now all the way to January of this year, so all of this has been retraced, and that is absolutely not great. And then looking at discretionaries, like I said, VWAP is your support, 219.13. Next support, 215, somewhere in there. Momentum selling, RSI still looks bearish. If this sells to the 21 EMA, certainly a possibility. That's about 5% lower from here. Got a couple levels, 215, 210 as potential support areas. But for now, with the trend line break here, I would expect to push into this zone, 210. Moving over to semis and oil and gas. Semis had a down week, 1.87. I just wanted to highlight this looks like a stalled chart. You had a big wick high, big dip low, consolidation, can't seem to close above 256.26. We had it briefly here in November and immediately gave all of that back. So seems like a chart that's waiting for the 55 to consolidate in here, and then it's going to break, in my opinion. And then looking at the oil and gas charts, 2 big weeks in a row, 5.5% and 2.7%. It is slowing slightly. We're getting into this kind of zone of consolidation. The highs here, 140.88 is the level. If we can break that, I think we'll head to 145.92, maybe even higher. Some potential trend in here. If we hit this trend structure again, that would give you maybe 152 potentially. This is more of a trading vehicle. It's not an investment in my opinion. You have some lows, you have some highs, pretty wide ranging. From top to bottom, that's about 25%. From top to bottom, if we got another 22-25%, that would give you this target in here. I think it could go. I would be patient though. Want to see the break continuation above that 140.88 level and the 55 EMA in there. So momentum bullish, RSI bullish. I like oil and gas in here. And then looking at wood and oil futures, I just wanted to talk about wood here briefly. Look at this volume, absolutely massive volume, 1 million.04 on the volume. The normal volume is about 40,000, 30,000, 45,000, but we got a 1 million traded here on wood at a critical level. Huge buy area here in February, and then you saw a huge rally, 13%, multiple buys in this zone, another 13% rally. Is this a zone to be buying, or is this structure breaking down? If you look at it, the huge volume came in on the Wednesday, and the next day was a huge gap up, big wick, and then we pulled right back to here. Something to watch in here, something's going on with wood, big volume, big spikes there. And then looking at oil futures, we talked about this consolidation in here. We got the break of the 73 level. Realistically, this is probably going back to around $81 a barrel. Moving over to market breadth. Breadth did go higher at some point, and then we gave it all back and finished bearish on the week. Not exactly what you would want to see. 20-day is still holding up. Very little changed relative to the previous high close, but still technically down 10%. Want to see it hold this 16 area. Momentum starting to step to bullish on the 20-day, so maybe we've seen a relative bottom, potentially. Maybe this goes a little bit lower with markets, and then we get a little bit of divergence between markets and breadth. Something to consider in here. And then looking at 50-day, nothing looks good here. Closed below the previous candles. Momentum bearish, RSI bearish. This says we should go a little bit lower. Your next level, if the 15 breaks, is that 10.5 area. This is where we got to back in October of 23, and that was the start of a very long-term rally. Just something to consider if we get into this range. It's likely at least a short-term buying opportunity. Moving over to 200-day breadth, same thesis really as the 50-day, just continues to crater. New relative lows. We're below the 50 mark, so we have negative breadth across on the 200-day now. So again, not a good indicator, at least for the medium term. Doesn't mean you can't see a short-term bounce, but medium term, this looks pretty bad now. Your next key level realistically is the 43.55 level now that this 49 has broken, but 36 is actually a more relative bottom. You can see some touches in here where you did stop at that 43 area and then bounce, but once you start to see these bigger sells, I would expect it to go to the 36 area. And if that's true, that means we got a pretty decent amount of downside still left before we see any kind of relative lows. Momentum still bearish, RSI bearish, does not look good. Moving over to the dollar, you can see the dollar was up on the week, 0.66, closed above 109.5. We talked about this several times during the week, but if it closes above this area and pushes back to these highs that we saw in September of 22, this was a big bottoming area for markets. Markets rallied strongly from there, and markets really have not reacted to this very powerful dollar, but it seems to be mattering now, at least in the short term. If this continues to break higher, 111 is the area, and then above that, you should be looking for these relative highs somewhere in here, 113.8 on the dollar. We are overbought once again, but momentum very strong, and this is a fundamental move with the new Trump administration. Again, I just haven't seen markets go with it. and I'm curious to see when they will. Moving over to bonds on the weekly chart, you can see J&K down 0.64, really not that different from where we have been. We're right at the 55 EMA, 95.32, closed above it by 2 cents. Structurally has not quite broken. Momentum and RSI both bearish though. And then looking at TLT, we've been talking about this one for a bit now. Seems like we're going to get back to these relative lows in here. 82.60, the low back from October of 23. I didn't think we were going to break through here. I thought we would see at least a little bit of a bounce from the April of 24 lows, but we have. We pushed all the way back into the 85 area. It's been a really big down move. Is it a medium-term buying opportunity? I still say yes. Just to give you some context here, the last time we were this low on TLT was back here in July of 2007. Then you had a really big up move all the way into the 170s. Are we going to go back there again? I doubt it. I wouldn't say that that's likely, but how much lower below this 82 level do we go? Pretty much not at all. 81, 82 is just about as low as it goes. So we are getting close to that area once again. And I do think that is going to be a very long-term buying opportunity once again. Moving over to the VIX, you can see the VIX was up 21%, right to the 20 level like we talked about. That was the target. Closed just barely below it. If it pushes through, your trend resistance is going to be 22.8. Momentum bullish, RSI bullish. Everything says the VIX should go a little bit higher, which fits with the bearish thesis. And then looking at my accounts, I actually did really well on the week. I traded really well on the Friday. I think I was still down just a little bit, but overall pretty good considering how down markets were. Just dipping my toes in, watching the Russell, very small, one put here at 215 for 66 cents credit. Really just keeping my eye on markets, very small deltas. Realistically, I think markets are probably going to go lower, and that's what I'm looking for. I just don't have any positions for it right now. Let me know down in the comment section what you think of the potential upcoming lost decade. Is it going to happen? How are you allocating your stocks and bonds or real estate? Otherwise, like and subscribe if you got any value out of this video. Make sure you hit the bell so you don't miss out on any future episodes. Of course, none of this is financial advice. This is all for entertainment purposes. Good luck in your trading and have a great day.